All right, let's get right into it. Today, we are breaking down the framework that people use to legally and dramatically slash their tax bills. Now, this isn't about finding a few extra deductions here and there, no. This is about a fundamental shift in strategy, one that completely redefines your relationship with the tax code. So let's start with this number, 50%. For a lot of high-income earners, when you add up federal and state taxes, that's what you're looking at, half of every dollar you earn. Just think about that for a second. Half of your time, your effort, your work could be going straight to taxes. That's the problem we're going to solve today. You see, our tax system is progressive, and that's just a fancy way of saying the more successful you become, the bigger the slice the government takes. It's kind of like a penalty for success, and it makes smart tax planning absolutely essential if you want to actually build real wealth, not just make a high income. Okay, so let's begin with what most people are already familiar with. We're going to call this Tier 1, or the standard playbook. This is your first line of defense, and it's what most financial advisors will tell you about. You know the drill, right? It's maxing out your 401k, putting money into a traditional IRA, using a health savings account. And look, these are all great foundational moves. You should absolutely be doing them. But for high earners, they have a very low ceiling. They just don't move the needle enough. The thing to understand about these Tier 1 strategies is that they all work by just reducing your taxable income. But because they have strict contribution limits every year, there's only so much they can do for you. This is what we call the employee playbook. It's solid defense for sure, but to really win this game, you have to go on offense. And that brings us to the single most important idea in this entire explainer. It's a total shift in perspective. What if you stopped looking at the tax code as a rule book designed to take your money and started seeing it as a treasure map, full of incentives the government wants you to follow? This is the core concept right here. The government uses the tax code to encourage us to do certain things, things it thinks are good for the economy, like providing housing, or producing energy, or creating jobs. The tax code is basically a massive reward system, and this is the critical shift from an employee mindset to an investor mindset. And just look at this comparison. It says it all. The employee playbook on the left, it just kind of chips away at your taxable income. But the investor playbook, well, that's about generating huge paper losses. Now, these aren't real losses. You're not actually losing cash. They're just deductions on paper, and you can use them to wipe out the tax on your main income. The scale here, it's just on a completely different level. So how about we put this investor playbook into practice? Let's do a deep dive using real estate as our main example, because it just perfectly shows how this all works. And why real estate? Simple. The government really wants private investors to provide housing for people. The magic here starts with a concept called depreciation. It is the ultimate paper loss. Basically, the tax code says, hey, your building is getting older, it's wearing down, so we'll let you deduct a piece of its value every single year. The crazy part? You get to take this deduction even if your property is making money and going up in value. But wait, it gets better. You can actually put the accelerator pedal to the floor on this. It's called a cost segregation study. It's a fancy engineering report that breaks your property down into all its little bits and pieces. The carpet, the appliances, the light fixtures, and it lets you depreciate all those things way faster. This creates a massive front-loaded deduction in the first few years. Okay, so you've got this giant paper loss from depreciation. Sounds great, right? Well, there's a hurdle, and it's a big one. It's called the Passive Activity Loss Rule, or PALS. In short, these rules create a brick wall that stops you from using losses from a passive investment, like a rental property, to offset the income from your active job. It's the government's roadblock. But this is where things get really clever. There's a well-known strategy to legally get right around that roadblock. It usually involves short-term rentals, and you have to pass these 3 specific tests. 1. The average stay for your guests has to be 7 days or less. 2. You have to materially participate, which means spending at least 100 hours a year working on the rental. And 3. That time has to be more than any other single person, like your cleaner or property manager. Now, if you check all 3 of those boxes, something amazing happens. The tax code looks at all the work you're doing and says, you know what? This isn't a passive investment anymore. This is an active business. It literally reclassifies your rental property. And that right there is the key that unlocks everything. Because your rental is now an active business, that roadblock, those passive activity loss rules, they just vanish. And now, those massive paper losses we created can flow straight through and wipe out the taxable income from your main W-2 job. So let's make this real. What does this look like in actual dollars and cents? Take a look at this number, $90,000. That $90,000 was the paper loss from a single rental property, after it had already offset all of its own rental income. That leftover loss was then used to directly reduce a lawyer's $300,000 salary. Just like that, their taxable income dropped from $300K to $210K. That is a life-changing tax saving from one investment in 1 year. Okay, let's zoom out for a minute. We've gone deep on the real estate tactic, but it's really just one example. What's the bigger picture here? What's the unifying principle that makes this all work? The principle is actually really simple. You put your money where the government already wants it to go. We saw it with housing and real estate. But the same powerful incentives exist for things like boosting domestic energy production if you invest in oil and gas, or for creating jobs when you start or invest in a small business. You're just aligning your goals with the government's goals. And that is the ultimate takeaway. The biggest, most powerful tax strategies aren't some secret, obscure loopholes. They're hiding in plain sight, disguised as economic policy. If you can understand what the government is trying to encourage, you can unlock tax savings you never thought were possible. So I'll leave you with this question. Every single time you file your taxes, you're telling a story. Is your story that of an employee who just works hard and pays whatever the bill is? Or is it the story of an investor who actively partners with the country's economic goals and gets rewarded for it? The playbook is right here. The choice is yours.